Navi Nifty IT Index Fund. Will this NFO help you achieve your financial goals? Who can invest in this fund? Who should definitely avoid this fund? Let us explore. Hi, this is Ramalingam from holisticinvestment.in. We help individual investors like you to take right financial and investment decision. Before analyzing this fund, let us understand the basic features of this NFO and Nifty IT Index outlook. Let us analyze, and then we analyze this particular fund. NFO is open till 14th March, and the minimum investment in this fund is just 500 rupees. This fund's benchmark is Nifty IT Index, and it is an open-ended fund. This comes under index fund category. The primary investment objective is to generate long-term returns by mimicking Nifty IT Index. This fund will simply buy all the stocks in the Nifty IT Index in the same weightage. Subject to the tracking error and expense ratio, this fund will give similar returns as of Nifty IT Index. Nifty IT Index has got top 10 stocks of IT companies based on free float market capitalization method. And those 10 companies are Infosys, TCS, HCL, Tech Mahindra, Wipro, L&T Infotech, Mindtree, Infosys, Coforge, and L&T Technology Services Limited. So the index is well diversified into these 10 stocks. And what is the kind of return the index has delivered in the past? Index in the short term has given negative returns. This performance is as of January 31st. Last 1 year return is 43%. Last 5 year CAGR is 31% return. From 97, how the index has grown is represented in the chart. You can have a detailed idea on this particular sector's performance. Now let us compare this IT index performance vis-a-vis the other indexes. Right? Compared to other IT indexes, they have done like a kind of above average kind of return, or average return is what they have delivered. There are few sectors which have outperformed IT sector. There are few sectors which have underperformed IT sector. But however, in the long run, IT sector was able to generate a reasonably good return. They are able to generate. As we have analyzed about the fund's key features plus the basic index, we have analyzed. What is the outlook? We have analyzed. Now we are going to discuss what are all the key findings which are supporting this fund. What are all the key findings which are against this fund? First, let us list down the key observations which are in favor of this fund. Potential merits. They are going to invest in top performing IT companies. If you are an investor who's looking for an exposure into IT sector with a low expense ratio, then definitely this fund is suitable for you. Suppose if the IT sector performs and delivers good return, then definitely this fund will increase your overall portfolio return. If you are a strong believer of IT sector's bullishness, then definitely this fund is suitable for you. Compared to an actively managed IT sector fund or actively managed fund, this fund will have low expense ratio. This fund is expected to have low expense ratio. If you are an aggressive investor who would like to invest in IT sector with a bullish outlook, then this may be a suitable option for you. As we have analyzed the key observations which are in favor of this fund, now is the time to analyze carefully what are all the risk factors involved in this, potential demerits in this fund, what are the drawbacks. because investing is nothing but managing risk. You can't directly manage returns. By managing risk, you will be able to manage return. So what are all the major risks involved in this fund? What are the potential demerits? We are submitting our key observations. Number one, this fund is obviously not suitable for short-term investors. When I say short-term investors, what do I mean by that is, if you have a time frame of less than 7 years, then obviously this fund is not suitable for you. If you have only 1 year, 2 year time frame, then this fund is definitely not for you. If you are an investor who has got a time frame of 7 years plus, this fund is suitable for you. Equities are basically for longer time frame. Being a sector fund, you may have to stay in the fund for much more longer time frame. This fund is not suitable for your core portfolio, because this fund is going to invest in one particular sector. This is not a well diversified fund, so obviously not suitable for your core portfolio. Returns can't beat the expected, beat the market. Being an index fund, they have to mimic and replicate the index. They will not outperform the index. In an actively managed fund, the fund manager will analyze and choose the best stocks in the index. That way, an actively managed IT index fund or actively managed IT sector fund can outperform IT index fund. This fund may underperform its index due to fees, expense ratio, and trading costs. So because of that, this fund will not even give returns equivalent to the respective index. This fund is not flexible and dynamic when compared to active funds. Normally, in a flexi cap fund, a fund manager can move from one sector to other sector easily. Whereas here, the fund manager has to stick to IT sector. There is no option available here. If the fund manager thinks the IT sector's outlook is negative, even then he has to stick to IT stocks only, because this fund's mandate is to simply follow the IT index. They will not be able to do any other changes, even though the outlook for IT index is negative. So that way, this fund is not having any flexibility, or they can't do any dynamic fund management. It is not possible in this fund. Because it is a sector specific fund, it is high risk. This will have higher beta. So volatility will be much higher in this fund. So this fund will reduce stability in your portfolio and increase volatility in your portfolio. This fund has got concentration risk. Number one, this fund is going to have only 10 stocks in the portfolio because index itself has got only 10 stocks. And number two, they are going to focus only on the IT sector. So it is not a diversified fund. The first investment lesson everyone learns is diversify. Don't put all your eggs in one basket. But this fund puts all the eggs only in the basket of IT sector. So that way, this fund has got higher concentration risk. If the banking sector, if the IT sector underperforms, then definitely this fund will underperform. Right? If the IT sector underperforms, this fund will surely underperform, and it may take longer time frame for you to recover. This fund doesn't do any analysis on the underlying stocks. This fund will not do any analysis on the underlying stocks. They will simply buy all the stocks in the index in the same weightage they will buy. They will not change the stocks. They will not analyze the stocks in the portfolio. If there are 10 stocks, what is their balance sheet? What is the profitability? What is the sustainability? How good the management is? What is the management's vision? They will not check anything. They will blindly invest in all the stocks in the index in the same weightage they will be doing it. No analysis, no research is done on the portfolio. We go to mutual funds because there is a fund manager who can do in-depth analysis, right? But whereas here the fund manager is not doing any analysis. So the main purpose of mutual fund is not met in these kind of index funds. Now, what is the final takeaway? Do we have to invest in this, or do we have to avoid this NFO? It depends upon what kind of investor are you. If you are a first-time investor, conservative investor, then definitely you have to avoid. If you are someone who's looking for a fund in your core portfolio, you have to avoid. One more thing which you have to know is there are existing IT index funds with less expense ratio and less tracking error. So why should you go for this NFO? That is another question that needs to be answered. Then if you are an investor who is looking for market beating returns or dynamic fund management, then this fund is not going to do that. This fund is going to mimic the market, so they will not beat the market. This fund is not going to manage the allocation dynamically. And as an investor investing in this fund, you should be able to predict how the IT sector is going to do well, when the IT sector's outlook is going to become negative. So based on that, you have to do the entry and do the exit. Otherwise, it will be definitely tough. Normally, in the actively managed fund, the fund manager does that. If the IT sector's outlook is good, he will have higher exposure to IT sector. If the outlook becomes negative, then he can move out of IT or reduce the exposure to IT stocks and move into another sector where the outlook is brighter. Right? Here, that responsibility is on you. You should be in a position to time the entry and exit of this particular IT index fund. In any sector fund, if you are not capable of timing the entry and exit, better to avoid. If you are an aggressive investor and you want to invest on the experimental basis, then in that case, in this NFO, invest with a minimum investment. If you have any further questions on this particular fund or any other investment option, feel free to book an appointment with our financial planner. The link for booking the appointment with our financial planner is available in the description box. Would you like to attend insightful investment webinars? Yes, we organize regular insightful investment webinars and it is completely free. The upcoming webinar is scheduled shortly. The topic is also a really interesting topic. You will love it. You can click the link in the description box and register for the upcoming webinar. You can learn the techniques to create long-term wealth. If you like this video, please give a thumbs up. If you know anyone in your social circle who would be interested in this video, please share it with them. Last but not the least, if you are not subscribed to our YouTube channel, please do so now by clicking the bell icon. Bye and see you soon.